Hey everybody, happy Thursday. We're going to have on Levi Carter here shortly. I'm Michael Marsh with CRNA Locum Jobs. So bear with us for a few minutes here and we'll get Levi on board. Levi owns CBFC accounting firm out of Oklahoma City, and he works with a ton of CRNAs. The three tiers of tax planning that he's going to discuss is it's going to be kind of based on not only how to tier your taxes, but also build wealth at the same time and figure out what the best things to do with the wealth and the money that you have coming in. Some of you probably, hopefully, are at lunch and able to join and listen in, or if you're in the OR, pop in a AirPod or something. There's Levi. What's going on, Levi?
Good.
Can
How
you
are
hear
you?
me? Oh,
Can hear you
good,
great. Can
man.
you hear me?
I
My
can hear
audio
you.
okay? Awesome.
Yeah, it sounds really good. I was telling everybody already that you're going to do the three tiers of tax planning today with us. Levi Carter, he owns and runs CBFC accounting firm out of Oklahoma City. He's somebody we've trusted as a company here at CRNA Locum Jobs, as well as me personally as a practicing CRNA. Works with a lot of our locum CRNAs as well as our other colleagues as well, even if you're W-2. But definitely focuses on the 1099 aspect. And today, doing the three tiers of tax planning, we're just going to go over not only how to build wealth, but also kind of negate some taxes as well. Um, Thanks for joining us, man. We're going to start doing a couple of these. I believe at least one or two a month. That was kind of the plan because we sent out a poll not too long ago and it said, what are you guys wanting to see as far as our clients and audience here on social media? And people were really interested in learning more about tax planning, especially with the amount of income we have coming in as CRNA locums or just in general as a 1099 provider. So we're gonna have Levi on talk about different things over the next several months, and I know it's a super busy time for you right now and your team. Tax season's here, but I'll let you get started. If you want to do a quick little introduction of what you're gonna go over today, that'd be awesome. I'll be here in the comments too. I'll jump on here and there with Levi, but if you guys have questions, please shoot them in the comments, and we'll get those answers for you either during or after.
Well, thanks, Michael, and just a shout out to CRNA Locum's Job. Just not just a great partner to us, but as we've partnered with more and more of your guys' clients, they're some of the best contracts of all the CRNAs that we serve. So you're obviously killing it on that front, and we're grateful for your contribution to wealth building for CRNAs as well. I'm going to keep this one brief. Nobody wants to spend an hour on their lunch break hearing about tax words and tax regulation. But this is more of a big picture session I'll do sometimes. I call it three tiers of tax planning. And it's all about what kind of tax planning should you be doing at what income level and to really maximize your wealth building. You're going to hear a lot of the same ideas on all the different forums from a tax planning front. But should you really have a Wyoming holding corporation if you're making 200 grand a year? What's going to be beneficial in the long run? And you want to take a bit larger view of how can I get my tax bill to zero? Because sometimes you can get your tax bill to zero, and maybe that's helpful from a tax perspective that year, but it wasn't the best thing that you actually could have done from a wealth building perspective. So we're going to start at the top. The top is good in this triangle. We're going to call it top tier tax planning. And what we'll do is I'll keep this brief to about 10 minutes. And there might be a few questions. We always spend more time on dialogue, but I just kind of want the dialogue to be centered around this big picture framework. Okay, so top tier tax planning, I'm going to read off my notes here, is when we leverage the tax code to reduce our taxes while keeping our money. So let me give you an easy example of this that everybody knows about. It's the S corporation savings. You file a piece of paper and magically pay $15,000 less in taxes. So I wish all tax planning was that easy. We kept all of our money. We filed two pieces of paper with the IRS. We shaved off $15,000. That's a win on the wealth building front because I got to keep my money. I can invest that. I can put that in real estate, crypto, whatever your thing is. Great from a wealth building front. Great from a tax planning standpoint. Let me give you another example of top tier tax planning. Michael and I just had, when we had our last in-person meeting, we were talking about something called the 1202 gain exclusion. This doesn't apply specifically to the CRNA world of a 1099, but you might own another business someday where this does apply to. It's the biggest, most lucrative, wild tax savings item in the United States tax code that nobody ever talks about, where you can literally sell a business for $10 million per shareholder, and that's actually the gain amount. You can have capital gains of 10 million per shareholder. So if you and your wife own a company, you can sell it for 20 million in gain and not pay any taxes. Are there a bunch of rules surrounding that? Of course there is. We build 1202 programs, but it's a wild piece of the tax code that if someone teaches how you can leverage this piece of the tax code in your world and your entrepreneurship ventures, you're going to keep all of your money. Okay, so that's another great example. Another more common example is all the things that we talk about with retirement, whether you choose SEP or solo K. What that is that's taking money in this pocket, my left-hand pocket, putting it in my right-hand pocket. I keep all of my money, and it's in a wealth building vehicle, investing in real estate. It's in a wealth building vehicle. I keep all my money, but I pay less in taxes. So that's where we want to start. And so if you're at 150 grand a year net, if you're at 200 grand a year net, if you're at 250 grand, you should be almost exclusively in these top tier tax planning things, meaning what's going to allow me to keep my money building wealth and still reduce my taxation. Okay, so let's move to middle tier tax planning. I'm just going to spend maybe 60 seconds on this one because it doesn't apply as much to 1099 CRNAs, but I think it's important to mention. I know there's a lot of CRNAs that maybe their spouse owns a company, maybe there's another company in the mix. This is business reinvestment. Okay, now in tier one tax planning, I kept all of my money. With business reinvestment, I'm going to let my money go temporarily, and then my money is going to come back to me with a return. And so I had a meeting last fall with a business owner who was going to do some strategic hires. They were high dollar hires. And he goes, well, I'd like to, build up some cash reserves. And I'm probably going to do this next spring, next May. And I said, man, if it's going to impact your business, let's front load some of these expenses. Let's pay the recruiter now before December 31st. Take the tax savings. If this money is going to leave the building in the next 6 months, or not, then let's go ahead and make the investment now. That means the growth on the back end of this investment is going to come that much sooner, and we're going to pay less in taxes. And so thinking in the lines of business reinvestment is really important if, in your future, or if a spouse owns a more of what we would consider an operating company that has expenses, where if we put more money into this machine, the money spits us back out a return. Okay, and then the third tier of tax planning, what I consider bottom tier tax planning, is I jokingly call this buy a truck tax planning. And this is where you go buy the 6,000 pound vehicle. And I just want you to philosophically think what's happening in that transaction. I'm saving money in taxes. So what am I doing? I'm going to trade a $20,000 tax liability, let's say, that I'm erasing. I'm going to trade that for $70,000 in debt or $60,000 in debt. And so was that a great financial move? I'm not going to say no, and I'm not going to say yes. I'm going to say it's a fundamentally different financial planning move than anything we talked about in top tier tax planning. There's a lot more that goes into that calculus. And so what you want to think, and if you put kind of a bullet point asterisk out to the side of bottom tier tax planning, is when you're comparing it to the other two. The first one, you kept your money. The second one, your money left and then it came back to you. And then in the third one, your money just left. Oh, and you picked up some debt. So the money's gone. You used it for a depreciating asset. So the money's gone in the third scenario. And so how this should work is you should have two corresponding arrows. You should be going down the tax planning tiers. We start at the top and go down as your income inversely is going up. So the only people that I should see doing bottom tier tax planning are people that are in these absolute highest brackets. That's where I should see bottom tier tax planning when, someone is actually netting taxable 350, 450, or at least that's the starting point of what we're going to net if we don't do any tax planning. I want to see in the mid threes. I want to see you definitely needs to have a 3 in front of it, should probably have a 4 in front of it if we're going to work all the way down there. Now, for those people, it's not only acceptable to do some bottom tier tax planning, but at that level, this money is just going to go to a government agency anyway. So it's actually responsible at that point when there's so much excess of taxable income that we're shaving from. It's a responsible thing to do to make sure that goes back into your life or your employee's life or your company's net worth, rather than to a government agency. Now, let me give you kind of an example of what I'm trying to explain there. Now, this is actually a top tier tax planning maneuver, but you can kind of get the point of what I'm saying. At the end of the year, in a lot of our companies that we serve, there will be a profit sharing contribution that we decide how much to give. And this might be with a company that has employees outside of just a 1099 CRNA, where they actually have to give a chunk of their money to their employees. Well, even if it's break even, like we've got to give $15,000 to this group of employees, but we're going to erase $15,000 of tax liability. It never works that way. It's always more efficient than that. But occasionally we come up with a scenario, depending on the number of employees, where that's the case. Even if that's one for one, the responsible thing to do is, well, I want this to go to my employees. Most owners will still choose to do that because they'd rather it go into investing in their employees than just being gone. And so it's kind of a similar thought. If you're in the highest tax bracket and you're considering things like, buy a truck tax planning, where yes, it's a depreciation asset. It's not the best thing for your net worth in the long run, but that money is just going to leave. Well, then you might as well put it in an asset that you can own and enjoy. So I get that. Another example of bottom tier tax planning might be some of the travel strategies that you guys talk about on all the CRNA forums. And here's how to make a lavish trip deductible. Well, that's fine. There's a place in the wheelhouse if you're in your highest bracket, but it's just another example of something where the money leaves, you pay a little bit less in taxes, so you pick up some tax efficiency. Is it okay to do that if you're in the highest planning, the highest brackets? Absolutely, you should do that. But if you're, a client with us, what I want to see is you've already maxed out the solo K. If real estate's your thing, you've already kind of done your real estate planning for the year and you're saving money that way. We're already structured the way. And then at the bottom, we have some money left over. We've done all the right things and we want to go on a lavish trip. Tell us how to make it deductible. Great. That's fine. We just don't want you to we just don't want to see you starting at the bottom and working backwards towards the top. So those are the 3 tiers of tax planning. Top tier is leveraging the tax code, loopholes, so to speak, to reduce taxes while keeping your money. Middle tier is business reinvestment. Our money is going to leave, but then it's going to come back to us. And then bottom tier is buy a truck tax planning, or simply where our money leaves. So those are kind of the big picture thoughts. Michael, I'm curious to get any thoughts that you have on what you'll see, just average CRNAs coming out. I'm curious to get your perspective on kind of what they're focused on doing with their money right when they come out. I usually see them really focused on the right things.
Yeah,
Everybody
yeah,
wants to buy the cool car for
mhm.
sure, but I usually, I'll see them come out of school, guns blazing. They haven't put money in a 401k for 3 years. They'll usually want to start at the top naturally. But just curious if you have any thoughts
Yeah,
on
no, I
that.
see that too. I think there's a lot of education that's been tossed around over the last few years with 1099 CRNAs, and it's become a lot more of a popular gig than it
Yeah.
has in the last 5 or 10 years. So CRNAs are getting out. They are starting solo 401ks or SEPs. And also, I don't know, does this fall into top tier or middle tier, but hiring a spouse or maybe your kids as an employee, CRNAs are really I think they're utilizing that and then adding their spouse on to their solo 401k because you can't add your spouse to that. So we're seeing a lot of that. And then the education of the S Corp. I think a lot of CRNAs are aware that they can elect an S Corp and pay themselves a certain salary, whether that be 80, 90, 100, 120,000, whatever you're trying to accomplish. If you're trying to accomplish the tax savings of the FICA, or you're trying to add more into your 401k. Maybe you could touch on that. I know that's probably a whole
Yeah,
different
yeah.
topic, but maybe touch on that for 2 or 3 minutes, just about how that salary needs to look from an S corp standpoint, being a CRNA, and if your focus is going to be more so on FICA savings, or is it going to be more so on the retirement savings? And if so, where do those numbers need to
Yeah,
land?
absolutely. I'm usually going to have that conversation annually. I mean, I guess we have CRNAs and we have a lot of other types of 1099 physicians that'll, where some of them I know they're always going to try to get 60 grand in the retirement plan, or 60 grand plus 20 for the spouse. That's actually, if I was to put a percentage of it, I would say that's maybe just over half or maybe 60% of our CRNAs. I've noticed a lot of younger CRNAs coming out of school directly into 1099. It's very different year by year. So they may, and part of that's because maybe they have a lot of debt in the picture. And so I think that's a responsible thing to factor into that equation. So we'll start with having just a conversation every year. Like, is this gonna be a big max out year? And then because if they then say no, it's not, I'm gonna repay some debt or I'm gonna do this, well, then I'm going to immediately swing the pendulum to, well, let's go as low as we can in your salary. However, we can make that a reasonable salary, but still a low salary. Let's take that savings, since I'm not going to pick up the income tax savings of this massive retirement deduction. Let's get some savings. Let's at least shave off this 15% payroll tax. And Michael knows this math well, but for those of you that might be listening to this later that don't necessarily know this math, the reason it's worth jacking up your salary to 150, 170, $180,000 maybe, and paying all these extra FICA taxes is because FICA taxes are 15%. And actually, once you get over the Social Security base, it's just Medicare. So that's just 4%. So you're trading this 15% aggregated with this 4%. So I don't know, let's make a fake effective number of 12%. You're paying this 12% surcharge tax to be able to pick up this income tax deduction that's worth maybe 42% if you're in the top tax brackets.
Yeah, because
That trade-off is
is it
worth.
25% is the max right now that you can put in from your salary. So that's where those numbers come from. If you're at 80,000 and you can only put in 25% of your salary, well, that's going to be, I don't know, around
Really
21,000.
limited.
But if you're at a $200,000 salary paying yourself as an S corp, now you can put in 50,000, and there is a max on that amount, that total amount. But that's where Levi and his team kind of talk with you guys and come up with a number that works for you, as far as, do I want to load this retirement account, or do I want to save that 15% in FICA taxes? And everybody always hears, well, 80,000, that's crazy. Well, remember, S corp, you are going to have that extra money sitting in your account. If you're a locum, you're making 350, 400 plus thousand. So you'll have that additional funds that you can take out as a dividend to yourself, but you're not going to pay the FICA taxes on top of that.
Yeah, yeah, and that's the basic calculation that Michael's alluding to is that 25%. That limitation only applies to the employer side, your company
Mhm.
side.
Okay.
So you've got to pay. Let's say you have wages of 100,000, and that spits out a 25,000 cap on the employer side contribution. You would get 25,000 there, plus you would get the employee deferral side of 23. So even that scenario, 100 grand, you could get up to about 43, or I think it just went up again a little bit this year, around 43,000 in the plan with the employee deferral, which, by the way, is the reason that it's almost always the right plan for a CRNA that's an S corporation. It's almost always the right thing to be a solo K versus a SEP, because you get that extra 23 grand in there.
Okay.
A SEP only has a company side contribution.
Gotcha. Can you speak real quick on how, because we'll get this question, how does the IRS perceive the $100,000 salary to a CRNA when, anybody can Google CRNA salary, and obviously you're seeing these salaries at 180 up to 300 grand W-2. How does the IRS perceive that salary? Because we get that question a lot,
Yeah.
even though majority of all CRNAs are sitting at an S corp salary to themselves anywhere from 80 to 120,000.
I have this dialogue with a lot, and I'll kind of with CRNAs a lot, and I'll let them be the leader on it. If they feel like, hey, it's more conservative for me to be at 150, 160, something like that, like a more conservative tax approach, I'll let them do that. The reason I'll let them guide down to that kind of lower threshold of 100, or I see 80 a lot, is because someone at some point started telling CRNAs, probably 20 years ago, set your salary at this amount, 80,000, 100,000. So when I'm getting a CRNA, a 1099 CRNA tax return from another firm, it's always at one of those two amounts, either 80,000 or 100,000.
Mhm.
The reason I put some weight on that is the IRS has a what they call a DIF, a DIF scoring system where they take the industry tax code on your return. So CRNAs have an industry NAICS code. They take that and then they compare the amounts on yours compared to everybody else that has that code on it. So it doesn't just apply to officer compensation. You might have $40,000 more than the average CRNA has on meals, and that might get flagged for an audit. And so I know that's the one of the primary ways the IRS flags officer compensation. If this attorney's S corp return is wildly off from the average of all these other returnees, and so that's why I'll let them kind of go down on that side. Again, it's less of an issue now with most CRNAs tending to want to go on the side of maxing out the retirement stuff. So we tend to jack up salary more often than we're going the other direction.
Yeah, just to
There
fit
is
in some more
there is some
retirement.
unique opportunities with part-time CRNAs as well.
Yeah.
I've got a lot of those where, we might give them a $60,000 salary because it's a, part-time work, part-time stay-at-home mom, part-time, they're still practicing. And so you can pick up some opportunities if you're
Okay.
part-time as well.
Back to top tier planning, and I know you said it makes a ton of sense for 1099 CRNAs to get a solo 401k. Tell us how you guys can help with that. I know that you can set it up at your
Mhm.
firm, and how is that handled? Because we'll get that question too. How can I set up a full solo 401?
So what we are to 401k, the 401k process is a third party administrator, and you can hire us to do that, but you legally don't need a TPA on a solo 401k until there's over 250,000 in assets. Now,
Okay.
if you do a rollover from your nurse days after you graduate, you might be there on day one. You don't need that service. So the most cost effective thing you could do is you could go to a Schwab or a Fidelity. Most of them will have a solo K option on their platform. Schwab is really clunky, but very cheap and very almost free. Fidelity is a little bit more user friendly as far as it feels like you're in the 2010s as far as the technology. You're not mailing in paper checks. So stuff like that kind of matters when we're trying to figure out things. So I like Fidelity as another low cost option. The only reason people might use us before they're at that threshold is if it's a convenience
Okay.
thing. Like, I don't want to mess with this. Well, then we can kind of concierge it, white glove it, and you're probably going to need that TPA in a couple of years anyway. Once you pass the 250,000 mark, there's tax returns. It has trust, as
Yeah.
401k has trust documents, but those are a few
Okay.
different options that you have.
Okay. And let's say we're getting to the end of the year, we haven't put in a ton in our solo 401k and it's December 20th. At that point, you can still load that solo 401k up. And depending on where you want to stand with taxes or what extra cash you have, that's when you say, "Hey, Levi, like I have this much money. I know we've only put X amount in the solo. Let's load it down," right?
So you're saying, like, the taxable year you're in September. and you go, oh, I don't want to pay this
Right.
much in taxes. I want to max out. Yeah, yeah. You can. We're usually doing two things there, and this is actually one of the only reasons that we do the payroll piece of this. Is it's easier for us to control all of the moving parts.
Hmm.
We're also usually actually jacking if we have that meeting and that person is in that position. We're also jacking up their compensation at the end of the year to get them to be able to contribute, get 60 grand in. They were thinking there was going to be a lower contribution year. Well, maybe we have their salary set at 110 and we've got to jack that up. So yeah, a lot of times we're doing these year-end special high dollar payrolls to get people where
Yeah,
they want to end up.
I think that's a good point to make because you don't have to have this all set up. But it's February right
Right.
now. You don't have to say, "Hey, I this is exactly what I want to do." If things change over the next 9, 10 months for you, you can pay yourself more money. You can put in more money into your solo. There's just so many avenues of different ways to handle the tax beast throughout the year that you don't have to have this set in stone January 1st of the new year. And I know you guys at CBFC, you do usually it's September, October, November tax planning as well. So you chat with your clients throughout the year, and obviously you're able to kind of do a white glove service and figure out what they're looking to do, whether that's save money on taxes or put more money in a solo 401k, or maybe they've decided, hey, I need to get into real estate. I have this extra money. I want to buy an Airbnb or a rental house. So you guys work on that. This is a thing we work on throughout the year, and I think CRNA sometimes get maybe a little hung up on. I have to have all this figured out January, February at the beginning of the year. You don't have
Mm,
to do that.
yeah.
I know you guys work with us throughout the year to make sure our planning is the path we want to follow.
Yeah, yeah, and to accentuate the timing piece of that, and just a reminder, or maybe people that are newer that don't know this, you actually have even till after the year closes for the company side contributions. So if cash flows tight for some reason at the end of the year, you've actually got up until the due date of your corporate tax return to do those employer side contributions. Nothing you can do after year end on the employee side. You got to get that at least that 23 grand in there first during the calendar year. But yeah, you even have till after the end of the
Okay.
year for the company side
Yeah,
contributions.
yeah, that's a good point. So jumping back to top tier, I know we're kind of sitting in
Yeah,
that. The S corp. How much does that cost to set up? And I know, let's say we're going to save 7 to 10 grand on taxes.
sure.
What's kind of the average rate that you guys charge, or that you'll see a CPA accounting firm charge for setting up or electing that S corp?
Yeah, I mean, you might have a CPA charge a few $100 for that filing. For us, we only take on kind of these monthly relationship clients, so I'm just going to take care of that inside kind of my what I view as my normal job.
Right.
So versus the charging a fee, but you might get that a few $100. Where I would pay a professional to do it is late elections, and these come up a lot, and a lot of times these are very worth the $10 or $12,000 worth of savings that you net of fee savings that you're going to get, and even net of payroll taxes. Basically, let's say a CRNA doesn't know any of this stuff, and they've practiced 1099 their first 6 months on the job, and then they learn about some of this stuff. It's August, and the deadline is passed for them to be an S corp for that year, but they've got almost a full year in earnings. You can get a late S corp election approved, but it's not an automatic rubber stamp. It's actually a human has to review it, and it's got to be done. So I would pay a few dollars to save that 10 grand. If you're on time, you've got 75 days from the first date of your LLC is alive. If it's on time, it's a 2-page form, and as long as you're careful to not miss a box or something, you'll be fine. Where I would make that investment, if you think it might be worth it to go ahead and file as an S corp, even though you're late, versus just waiting till the next year and taking the $10,000 hit. It may be very worth it. So you might want to spend a few dollars and have a CPA do it if you're in that position.
Gotcha. Yeah, I believe, and I think you would agree with me, if you're making if you're full-time locum or full-time 1099 CRNA, you need to file as S corp. Where's that line drawn in the sand as far as sole proprietor LLC S corp? If you're going to be part-time, let's say you're a W-2 employee and you have 1099 income on the side. And then the second scenario is somebody who is just a part-time locum or a part-time 1099 CRNA, maybe making, you can tell us
Yeah.
the ranges 80 to 100,
You'd
150.
have to be extraordinarily part-time for it not to make
Okay.
sense, because remember, we can lever the salary down at that point too. So, I mean, I would say you'd have to be significantly below 100 grand of gross, or, somewhere around 100 grand is where you're going to net, because then I can take the salary down to 50 or 60 if it's someone just working extremely part time. And then I've got 15% FICA taxes on this 50 grand on top of the 50 grand salary, right? So then I've immediately got 8 grand of savings,
Right.
even in a part time scenario. So, the other reason is, and this will be another call, but is when you have wages, you get to keep QBI, which is another lucrative
Mhm.
deduction. So that's usually what puts us over the top, where almost all of our CRNAs are S corps.
Okay.
So anyway.
Great information. We're at 30
Yeah.
minutes, Levi, and I know everybody listening and that's going to listen. We're going to continue to do these 1 or 2 times a month with different topics. Today, Levi went over the 3 tiers of tax planning as well as kind of wealth accumulation, us being 1099 CRNAs and the amount of money we're bringing in. Taxes are obviously very important, as well as you guys working on creating that wealth. We're super thankful, man. I know, like I said, you and your crew, this is a busy time of year, but everybody watching and everybody who's inquired about this kind of stuff, we're happy that you've joined us.
Thanks so much, Michael. Look forward
Hey,
to seeing you soon.
you're welcome. I do want to tell everybody in our link tree, we do have Levi's website. It's CBFC. Just let them know that CRNA Locum Jobs brought you over to him. But I believe you worked with almost 100 or more CRNAs. So their crew is very involved with the CRNA community. And he's been working with me for years, as well as our company, CRNA Locum Jobs. So thankful, man. We'll talk later this month, and we'll do this again with a new topic.
Looking forward to
Okay.
it.
See you, Levi.
See ya.